Hello, everyone. My name is Mark Dolfini. It is so very good to see you. Whoa, that was crazy. It's so very good to see you this evening. This is one of my very favorite topics to discuss. We're talking about finances. We're talking about money. We're talking about financial statements and balance sheets and income statements and P&Ls and all the fun things. I geek out on this stuff, right? My background is in accounting, but those of you who are already starting to get your palms all sweaty, mom spaghetti, vomit on your sweater already? Don't worry. Don't worry. We're going to make it nice and easy. We're not going to be talking about debits and credits. We're going to be talking about stuff that is absolutely relevant to you as a business owner so you can understand some financial stuff, right? So, before we get too far in the weeds on that, I know there's still people still coming in. And I know it is a different time zones, all over the place. So people are showing up here. I'd love to know. Again, Michelle put that already in the chat. Where are you watching from, and what line of work are you in? Would love to know that so we can make this a little bit more specific to you for the training. So we always get lots of questions, and if this is going to be recorded, yes, you will get the replay. So I'm just letting you know that now. You will get the replay. We'll be sending that to you in your email. So please watch out for that. My extension is markdolfini.com. So please keep an eye out on that, especially if you have a Yahoo or Gmail address, because they just seem to hate me for some reason. They always just stick it in spam. So there's that. The other thing I want to talk about really, really fast before we get into this, we have a lot to cover, I'm just asking not to multitask, because we're going to get into some granular stuff here. And I know right now people are like, okay, this is financial stuff. It's like the last thing you want to think about, especially at the end of the day. But here's the interesting thing. Like, this is stuff that's really going to be very relevant to you, and how you're going to be looking at financial statements. And the thing is, right now, I know a lot of people are like, oh my gosh, I'm not a numbers person. Who in here identifies as like not a numbers person? If you are identifying yourself as not a numbers person, it's okay. But I want you to understand something fundamental. Accounting isn't about rules. Accounting isn't about numbers as much as it is about rules. So if you can understand the game of solitaire, if you can understand the game of Monopoly, if you can understand Candyland, you can understand this, because it is more about rules than it is about numbers. And it just communicates in numbers. Numbers are just representations of what happened. So I don't want you getting all freaked out. I'm not a numbers person. If you can handle a 4-function calculator, add, subtract, multiply, and divide, and generally it's more adding and subtracting than any other thing, you can handle this. Okay, so I'm just going to show you, this is not advanced crazy math. So I just want to make sure that you guys are in good shape. All right, so let's get to first and foremost, what we're going to do is, so we got all that set aside. So please don't multitask, and we'll stay plugged in. I'm going to try to be close to the top of the hour as possible. One quick thing I just want to make sure that you guys are aware of is I do have an offer at the end. There's some free resources that I want to send you to, and there's also there's a paid version of the course. I have a money and finance course. And I just want to make sure that you are aware of that at the very end. If you're interested, if you're not, totally fine. I just want to make sure that you knew that at the very end, there's more to this. So if you are ready for more and you'd like to know what that looks like, I'm going to show you the free resources first, and then I'll let you know before the paid thing comes up at the very end. All right, so let's get to it. Again, let us know where you're from, and let us know what line of work that you're in. I would love to know about that. So let's get to the agenda first and foremost. The agenda, first and foremost, what I want you to understand is we're going to be taking a top-down approach. As a business owner, it's important that you understand a strategic approach to your business and also how it relates to your life. So a lot of this stuff, there's a reason why you want to understand your finances, especially your financial statements, because all of the activities and things that you do are representations on the financial statements, on the balance sheet, on the income statement. So there's a reason why you want to know all this stuff. You want to know, are you heading into financial problems? Are you growing broke? Growing broke is a real problem for companies, especially as they are growing, and they are growing at an exponential rate. You could be growing fast, which is fine, but you could be outgrowing your ability to generate cash to fund future growth. And that's what I call growing broke. And there's lots of ways to actually grow broke. And what all of a sudden you're growing, and then all of a sudden you're running out of cash, and you're like, oh my gosh, I can't pay my bills. That's the problem. And now all of a sudden you're waking up at, in cold sweats at 2:30 in the morning, worried about covering payroll and worrying about being able to pay your vendors. And you've got more and more customers coming in. You're like, oh my gosh, I don't know what to do. So this is a really big problem with lots of companies that are growing and they have exponential growth. So they're like, well, I got to borrow. So then they start funding more and more on their credit cards, which is really expensive debt. Not so much not, yes, of course, from the purpose um, of interest, but it's also something known as a loan constant. So a loan constant is for basically how many dollars will it take to service, say $10,000 worth of debt to service that on a credit card is really expensive cash flow based on $10,000 of, say, money that was amortized over 30 years, right? So that's what I'm talking about, a loan constant. So these are the sorts of things that I just want you to start to be aware of, because and I'm going to give you this framework first and foremost. So the first 10, 15 minutes or so is going to be about business framework. And then I promise we're going to get into the financial statements. So give me just a few minutes of grace. This will all make more sense at the end. But at the end of the day, I'm a strategist, which means I take a top-down approach. If I just went right into financial statements, there wouldn't be enough context for you really to understand. I want this to stick. I want this training to make sense for you. So please just hang in there. So Karina from Long Island, waiting to start a business. Very good. Karina, I grew up in the Catskills, so you probably know where those are. So I live in the Midwest now. All right. So the first and foremost, we're going to talk about the Viper method and the personal and business framework about how to get a business started. So Karina, this is going to be right what you need. Secondly, we're going to talk about the 4 core functions of business, where every business has to have all 4 of these functions. Then we're going to get into the financial statements. So we're going to talk about balance sheets. We're going to talk about income statements, P&Ls, things like that. So we're going to talk about all those different things. We're going to talk about the basics of those things. And then you're going to be thinking, oh my gosh, where's all my cash? And this phenomenon that I just mentioned about growing broke. And finally, we're going to talk about the resources that I mentioned. There's some free resources and there's some paid resources. These are all the books that I have written. And you're thinking, well, who cares? Well, I'm not saying that to impress you. I'm saying it to just demonstrate to you, like, I've written a lot of books on a lot of different things about all of the mistakes that I have made, specifically in real estate and all of the different businesses that I've been in. And you can get it wrong a lot more than right and still do pretty well. So I'm just want to let you know that most of the books, most of the topics about the things that I've written about are things that I have done wrong, and how you can avoid that and how you can do these things right. So I'm not here to sell any books or anything like that. This is the copy of the Time Wealthy Advantage. If you are interested in getting that and you don't live in the United States, I know there's people who frequently come to these sessions that are outside the United States. My suggestion is go to Amazon. That's probably your best bet. But if you do want a signed copy, I can get you a signed copy if you buy it off of strategicboardroom.com. But again, I'm not here to sell that. I just want to let you know that the Viper methodology comes from this book. Now, the Viper method is an acronym, and that stands for Vision, Infrastructure, Process, Execution, and Reporting. This is the business framework about how I coach and consult people and advise people when they're putting their businesses together. So Karina, this is going to be right. This is going to be right what you're probably needing at this time. I don't know how deep you are in the trenches on this, but this will probably resonate with you. So let's first and foremost unpack vision. Vision is specifically where it is that you want to go, right? It's like the purpose of your finances. You're thinking, okay, well, obviously not everything is about money, but yeah, if you're going to be funding a vision, it kind of makes sense for you to know how much money you're going to have so you can fund that vision, right? Now, vision has 2 components. Vision has a personal vision component and it has a business vision component. Let's talk really quickly about personal vision. Personal vision is where you want to go in life. Okay. So think about this for just a hot second. We're not going to spend a ton of time on this, but personal vision is, what would your life look like if it wasn't defined by income generation, right? If you didn't really have to worry too much about what was on your income statement or your balance sheet, right? Where would you want to go? And your business vision is you're saying, okay, cool. That's where you want to go in life, right? This is the kind of life you want to live. Great. Your business vision is going to be like, okay, great. How are we going to live there? Now, a couple hours ago, I did a session for Business Plans 101. And this is exactly the type of thing that you're planning for. This is the business vision that exists to serve your life, right? This is what you want in your life, and you're going to reverse engineer a business that exists to serve you. And the problem is that many business owners that I talk to, especially many entrepreneurs, because they're so fired up about their business, right? The danger in creating a business vision without ever giving any consideration to a personal vision is that you end up creating a life that exists to serve the business. And I'm just telling you that that sucks. Like, I've been down that road where my whole life existed to serve my business. And in the early days of entrepreneurship, and it's exciting and everything else, and everything's about your business. Yeah, that's fine for the early days. But I'm just letting you know that create that personal vision. You're doing it because you want a better life. I'm assuming, right? So define what that better life looks like. The way that I suggest doing this, and just hang in there for a few more minutes, because I'm just going to do this really quick, and then we're going to get into the business stuff. I promise. Just hang in there for just a hot second. But when you're defining your personal vision, one of the things that that I suggest is come up with your 100th birthday speech. For those of you who are like, you're like, dude, I'm like in my mid 20s. Like, that's so far away. That's just not tangible. Okay, fine. But think about maybe a life event, right? Or a milestone for you. Maybe it's you turning 30 or 40, or maybe your kid, maybe you got kids, or your kids are turning into teenagers or something, right? And they morph into teenagers, and then they become humans again on the other side. I promise it does happen. We've got a 20-year-old, a 17-year-old, and a 3-year-old. So we're at like parenting 501 right now. But the thing is that, the personal vision, come up with your 100th birthday speech or that milestone speech, and think about who you would want to be in the room. And what would you say? What would you say to the people that were in the room? And, you start thinking about what you would say, what would be the message that you would want them to take outside the room when you were done. But just think about that, give some thought to that personal vision, and write it down. Write down what you would want your life to look like if it wasn't defined by income generation, and what would be the message that you would want people to take outside the room at that milestone. Okay. So we're going to put the fries in the bag on personal vision. Let's start to talk about business vision. Now, what I'm going to tell you about the business vision, this is foundational. And if you have not done this work, I'm really going to impart on you to take the time, not now, because I'm asking you not to multitask, but to take the time at some point in the future that you're going to do this around your business vision. So there's 3 components to business vision, which is core purpose, core values, and client avatar. Core purpose, core values, and client avatar. Your core purpose is specifically what business are you in, and specifically what problems do you solve. If you're not clear on this, I'm telling you that your business is going to struggle, because you're going to start to get really fragmented, and it's going to show on your income statement. It's going to show on your balance sheet. And if you hope to ever borrow in the name of a business, that's actually a session that I host. I actually held that last week for the first time, and it was like, people really enjoyed it. Like, people want to know how to borrow in the name of a business, because they want to get their credit cards cleared up, and they want to be able to get loans in the name of their business. You've got to have a core purpose dialed in, and you really got to have clean sets of financial statements, balance sheet and income statement. And if you're sitting in front of a loan officer and they're like, hey, what kind of business are you in? And you start giving them like all this fragmented answer, they're not going to really feel that warm and fuzzy. And I'm telling you, you got to sell these loans to these loan officers sometimes. And if your core purpose is not dialed in, they're not getting that warm and fuzzy. So beyond the scope of this session here to talk about lending, but I'm just telling you, if you really want to start making some money, don't worry about getting too far down into a niche. Really get dialed in on your core purpose about specifically what business that you're in and what problems do you specifically solve. Core purpose, look, I'm going to be honest with you, this one's a little squishy, but it is so incredibly important, as you need to think about what matters to you about this business, and how would the world be worse if you are no longer in business. And the reason this is so important is that companies that have the strongest amount of growth, and I'm talking whether they were publicly traded or privately held, the ones that had the strongest amounts of growth had well-defined core values, because they had well-defined company cultures. Okay, I said that backwards. They have well-defined company cultures because they have well-defined core values. So you want to define these core values, but what specifically is important to you, and write them down. Don't just stick them on a wall somewhere. And even if you're like, well, I'm a solopreneur, like this isn't going to be relevant to me. Yes, but at some point you're going to probably hire someone. You are going to need someone, whether that's an outside vendor, a subcontractor, or someone to do your books, to handle your fulfillment, to do your lead gen, to do your sales, something, right? Because you can't do it all. You won't be able to do it all. And I'm just letting you know that that was one thing that really held me back for a long period of time. is that I thought that I could do it all. And let's face it, many entrepreneurs and many solopreneurs that I work with, they're really smart people and they have a really good work ethic. The problem is that they're really smart people and they have a really good work ethic. And you're thinking, well, how is that a problem? Here's the problem. Because they're so smart, they figure that every problem that comes across their desk is a problem for them to solve. So all of a sudden they're like, oh, that's a problem. I can figure this out. And because they have a great work ethic, they'll work like 20 hours on that problem until it's solved. And that can be a real problem, especially when they're not delegating lower end tasks to other people that can solve other problems for them. So I'm just saying, not every problem that comes across your desk is yours to solve. And this is why you're going to need well-defined core values so you can start attracting not just customers that are in alignment with your core values, but also vendors and employees that are in alignment with your core values. Okay, so this is important. So take the time to do that. The last piece of this, and we'll be done with the business vision here, but is the client avatar. So we talked core purpose, core values. Now the last piece is the client avatar. Now, if you're trying to grow your company and you're trying to see top line sales, which we'll talk about that on the income statement, but you want to see growth in top line sales and making more revenues, and you want to keep more dollars, you want to have your ideal client avatar well defined. Who specifically do you want to serve, and where are they located? What are their geographics? What are their demographics? What are their psychographics? Geographics is specifically where they are. Demographics is who they are. Like, are they married? Are they single? Do they have kids? Are they educated? Etc. And then finally, the psychographics is how they think and how they buy. So when you're thinking about this from a marketing perspective, I'm not going to spend a lot of time on this because this is for the marketing class, but this is just really important for you to understand, is that think ALIA, ALIA. You're thinking attitudes, lifestyles, interests, and aspirations and goals. And when you understand this, now when you make an investment in marketing, which is an accounting function, when you have dollars that you're putting out there for marketing, you can do this in a much more efficient way, much more efficiently, much more effectively. So if I take a $10,000 marketing, the $10,000 marketing budget, and I invest that in marketing, like that's an investment. I want to see that each one of those $10,000 brings back $3 under each arm, right? So I'm like, okay, I put out 10, I bring back 60. How do I do that as many times as possible? And that's something tracking called RMI, return on marketing investment. So these are the sorts of things that you're going to want to track, and you can be much more effective and efficient when you know their psychographics, when you know their attitudes, their lifestyles, their interests and aspirations. So it's beyond the scope to get into this any deeper, but I just want you to understand how understanding finance impacts all of this stuff. So those are the 3 C's of business vision. If you're not clear on core purpose, core values, and client avatar, please take the time to get really deep on that. The next piece here is infrastructure. Now you're going to be making investments in infrastructure, right? Infrastructure are things like the bones of your business, the desks, the chairs, the software, things like that, right? Websites. And that's really important. And that's something that you're going to need because, you can't have all these processes without infrastructure. So you need this sort of stuff. And this is why, when you're looking at your vision, when you're thinking about your vision, your infrastructure has to be in alignment with your vision, right? That's why vision comes first. So you come up with a vision, that infrastructure supports that vision, and then you have process that works on the infrastructure. So let's talk about process for just a second. Process is simply how you do stuff. It's the tactical process and the strategic process. Tactical stuff, I'm just going to talk about this, the tactical, that's the day-to-day stuff, right? That's just basically how you do stuff from a day-to-day. It's your SOPs, checklists, day-to-day activities. This could be your opening procedures and closing procedures, right? How you answer the phone, but it could also be like how you do bank deposits, right? How do you reconcile the checking accounts, right? And not necessarily you, but if you're scheduling with someone who is doing your books, like you need to make sure that what process they're following. And this is really important to say. Let's say you don't even know how they do it. That's fine. But you have them define how they're doing it. Say, hey, give me a summary of what you did at the end of the week so I know what processes you followed, right? That's absolutely something you can have. Let's say it's a virtual assistant. That's absolutely something that you can have them do because you're paying them. And now what are they doing? They're creating an SOP for you. They're creating a standard operating procedure for you. And that is how you should be using your virtual assistants. So that's your tactical process. That's just basically your day-to-day stuff, how you're creating your checklist and so forth. The strategic part is the strategic planning part, the people, purpose, and promotion. This is like, think of the infrastructure and tactical process as the system. Like you created this boat, and the strategic planning is like, okay, cool, I'm going to take that boat out of the harbor, right? So that is great. And guess what that takes? Yep, it takes people. It takes purpose. You want to know what direction you're heading in, and that takes promotion, letting people know, inside and outside your organization where you're going with this, like communicating with them what you're planning on doing. But guess what it also takes? It takes money. And you need to know that if you're going to send out another $10,000 worth of marketing dollars, or $100,000 or $1 million worth of marketing dollars, that you actually have the capacity in your production to do that, right? So you really need to make sure. This is why understanding your financial statements, your balance sheet, your income statement, this is really critical to strategic planning as well. So the execution piece, so we talked vision, we talked infrastructure, we talked process. Execution is just making sure that things actually get done. It's the most important stuff. This is a great quote by General George S. Patton. He's an American general. A good plan violently executed now is better than the perfect plan executed next week. And the reality is most plans fall apart in execution. And I'm just telling you right now, and I'm going to mention this later, but the reason why I'm making such a big deal about execution is because you guys are going to learn this stuff and you're not going to execute, right? You really, most businesses in the 4 core functions of business, I'll come back to this, are lead generation, sales, operations, and accounting. And if you're going to ignore something, it's almost always the accounting. That's what always gets ignored. And that's why people are like, they either get freaked out about it because that's like, oh, I've ignored it for so long, it's not going to get any better. It doesn't get better on its own. It just doesn't. So this is why you need to execute when you're looking to hire someone. You do need to execute on this. And generally, it's most of the reason why people don't execute well is because they have too many priorities. And having too many priorities has the same impact as having none. So that's why I like to boil it down to a daily 5. And these are the 5 most important things that you're going to do every day that it's going to move the needle towards your vision. So this is important. This is really important towards like lead generation and sales specifically. But if you are going to execute about having really clean financial statements, this is going to take intention. So the last piece here is reporting in the Viper methodology, and then we're going to be done with this. So thanks for hanging in there with me. But the reporting function, it's pretty straightforward. It's lead metrics and lag metrics. Lead metrics tracks your actions and activities. Lag metrics are the results of those actions and activities. So everything on the balance sheet and everything on the income statement is what has happened in the past. And that's really important because now it starts to tell you your performance. So we're going to talk mostly about lag metrics here later on. And we're going to be talking about different things like, profit as a percentage of sales and different other metrics along those things. We'll get to that here in just a little bit. I don't want to get too confusing. So that's the Viper methodology and the Viper framework. So let's talk really quickly about the 4 core functions. The 4 core functions of business have to be true in every business, and they are lead generation, sales, operations, and accounting. And your customer's journey happens in this order. It starts with lead gen, sales, operations, and accounting. And the accounting function tracks all of that stuff. It tracks profitability. It tracks how much you spent on lead generation, how much you're compensating your salespeople, or how much you've made, right? That's kind of important. So I'm just letting you know the accounting function should not ever be ignored. It has to, these are the sorts of things that let you know how effective is your lead generation, how effective is your sales, right? Are you making money through the operational function, right? So the 4 core functions of business, when it comes to lead generation, everything needs to support the lead generation function. Why? The reality is this, and I know this isn't a lead generation thing, but I cannot make this point. I can't make this point strong enough. I've worked with clients who were bringing in easily mid 5-figure to 6-figure a month. And all of a sudden their leads dried up and the leads died off and they went on the struggle bus. So the reality is this: you can have the best product, the best idea, the most effective, efficient business, right? You can be a paragon of virtue, and your sales technique is so dialed in, you can sell ice to Eskimos and voting booths to Castro, and you can still starve. So understanding your finances is like, hey, cool, this is great. How much we know that our lead generation function is effective. How much more gas can we pour on that before we start growing broke or before we start having other problems? Okay, so this is why you got to have a really good understanding around how profitable your business really is. So you can never take your foot off the gas when it comes to lead generation. When you've got more leads coming in than you can handle, that doesn't sound like a bad problem to me. That sounds like you need to raise your prices. So that's about pricing strategy. That's beyond the scope of this right now. But I'm just saying, when you have enough leads coming in, like more leads than you can handle, it's not necessarily a bad problem to have. It sounds like you need to raise your pricing. So, but you cannot ever take your foot off the gas. You cannot ever take that for granted. So that is the lead generation. Sales just basically closes the conversation that's started by your lead generation function. And it understands that effective selling is about finding solutions. It's not about holding people's heads underwater until they say yes. The operations function is just whatever it does. Like if you're a roofer, you put on roofs. If you're if you make websites, this is where the operational fulfillment function comes in. And like I said before, this is the accounting function. If you're going to ignore something, generally it's the accounting function you're going to ignore. And this is, I don't know why people ignore it, because accounting function collects the money. Like, it tracks the money. Like, I kind of would want to know that. The accounting function also pays the bills, and it also tracks and measures everything that happened. So the other thing that's really cool is it also forecasts, budgets, and plans for what will happen next. And that is something that if you're looking for someone to support your idea, let's say you're looking for an investor for your company, this is really important for you to understand why, what a clean set of balance sheets looks like, what a clean set of income statements looks like. This is important. And also what a clean pro forma looks like. So you can really understand it. Now, I'm not going to talk about pro forma. Pro forma is just a projection, right? That's just a projected income statement, projected financial statements is basically what a pro forma is. But you're going to see a sample income statement here in just a minute. But I just want you to stop for just a second. For all these four functions, right? Remember, lead generation, sales, operations, and accounting, are all these the same skill set? No, they're not the same skill set, obviously. And this is why you need different people in your organization to help you out with these things. So we talked about the Viper methodology. We talked about the 4 core functions. Now let's start to get into the actual financial statements. This is why you're here. Okay. So hopefully I've given you some context in terms of why the balance sheet and income statement are important, because it supports all of these functions in the setup of this business and the continual maintenance of this business. So when it comes to financial statements, there are 2 main financial statements. There are many, depending on how you want to slice and dice your data, but the financial statements that come into play are your balance sheet and your income statement. Has anybody ever heard of an income statement or a P&L or a profit and loss? A P&L or profit and loss, they are the same thing. So if you hear income statement, P&L, profit and loss, they are all the same thing. It's just vernacular. It's just a difference of words. So I'm an accountant by training. Like, that's my degree. I have a degree in accounting from Purdue. I call it income statement. I'm kind of an accounting purist, so I call it an income statement. But there's other people who call it a P&L, profit and loss. That is all the same thing. So I just want you to know that those are the same. So balance sheet, this is going to get a little basic. Okay. So hang in there with me if this is a little bit more, a little basic in the beginning, because we are going to get to more advanced metrics and KPIs near the end. KPIs are key performance indicators. So hang in there with me for just a second. Again, this is about you understanding the basics. So when it comes to a balance sheet, there are 3 main components to a balance sheet. They are assets, which is what you own. Assets are what you own. The liabilities, which is what you owe to others, and the equity, which is what the business is worth on paper. So if you subtract the assets from the liabilities, or you subtract the liabilities from the assets, where the assets are what you own, you subtract out the liabilities. Let's say you sell all your assets, you pay off all the liabilities. What is on equity would be conceivably what would be left over. That's basically called book value. All right. So I don't want you getting too hung up on that, because businesses can be worth far more than what is on their balance sheet. But I'm just letting you know that is a balance. So this is what this is. The balance sheet is also a snapshot in time. It's a snapshot in time. So in other words, today is November the 20th. So if I pulled a balance sheet for my business today, it would be different. I mean, if someone's like right now paying bills, which it's the middle of the night, so they're not paying bills. But if someone was paying bills, and if I pulled it at 7:30 and then I pulled it again at 8:30, the balance sheet could be different. So it's a snapshot in time. So I just want you to understand what that balance sheet actually needs. It's the balances in all of the accounts at any given moment. Okay. So it's important that you understand that. The income statement is, and on the other side of that, the income statement is actually, it tracks things over time. So it's over a period of time. So that'll make more sense here in just a hot second. But when you're looking at your income statement, again, those are made up of three things: income statement, P&L, again, all the same thing. You have your revenues, which is your sales. Okay. So it's the money that you brought in. It's your expenses, which is what you've paid out. And what's left over is either a net income or a loss. Generally, it's your profit. So if you have more revenues than expenses, you have a profit. If you have more expenses than revenues, you have a loss. All right. So that's the basics. Okay. And again, generally, when you're looking at an income statement, that could be over a period of time for say, a month. So I would be looking at my last reconciled month, which would be October 1st to October 31st. Okay. So if you've got questions along the way, put them in the chat. I promise I want to get to them. I just want to make sure that you guys are understanding, because I know I'm kind of going a little bit basic here, but everything here. So I'm going to take myself off the screen, or at least put myself down in the corner. Everything here has been excerpted from the Time Wealthy Advantage book. And this is just a very, very simple balance sheet. It's a very simple balance sheet example. So everything, if you look at the assets at the top, again, what you may notice, there's cash balance up here. Okay. So you've got cash balance at the very top, then accounts receivable. Okay. Then you've got total assets, then liabilities, and then your equity at the bottom. So let's take a quick look at what the balance sheet looks like from an asset perspective. So let's look at the assets. Assets, again, are what you own. So the reason why you'll see cash and accounts receivable and things like that at the top, and real estate and vehicles and stuff like that at the bottom, is because it's listed from what's an order of liquidity. So what that means is, what could I convert to cash the fastest? Well, if it's cash in a banking, a checking account, I can convert that to cash pretty quick. If it's savings bonds or some sort of corporate bond, I can convert that to cash pretty quick. If it's equities, right, meaning like I'm holding stocks, that's something I could liquidate pretty fast, right? If it's accounts receivable, that's money that's due to me or due to the company, by someone has to pay that. So that's not super. It's not as liquid, but it's still pretty liquid. I'm waiting that money. Sometimes it might just take a phone call. Hey, man, you owe me $30,000. Can I put that on your credit card? I'm like, sure. So that's what I'm saying. Like, it can be converted to cash, but generally it's not as liquid as cash in your checking account. Okay. So that's an order of liquidity. What's less liquid is like vehicles or machinery or equipment. Okay. Let me get my shiny dome out of the way here. So this is where you're looking at like accounts receivable. You got vehicles. So let's say your vehicles, you got a 2019 Ford van, and then real estate, which is a warehouse of $275,000. So all of these things added together is $417,000. All right. So again, these are the balances in these accounts. And again, just to be clear, like the vehicles and real estate that's on there, that is put on there at book value, meaning what it was purchased for. So it would not be necessarily like Kelly Blue Book value, like the vehicles or anything like that, but it would be basically what you purchased it for. So let's take a look. So again, that's the top part of the balance sheet. Let's look at the bottom part of the balance sheet. This is liabilities. Liabilities, again, same order of kind of liquidity, but it's more like which are short-term amounts that you owe out versus long-term amounts of money that you owe out. So again, if you have a credit card balance with Chase, that's short-term money. So the balance say at the end of the month, at the end of October, for example, is $34,760. Let's say the balance that's due to vendors that you need to pay out is $37,500. Wells Fargo van loan, you borrowed money to buy the van. That's what you owe to Wells Fargo, is $11,570. And then you have a real estate mortgage with Citibank of $105,350. So the total liabilities is $189,180. I subtract the assets minus the liabilities, and what's left over is the total equity is $227,915. All right. So I get this question a lot. And I get people who watch this from international. This is what's called GAAP, GAAP, Generally Accepted Accounting Principles. So you might be saying, well, is this the same if it's in euros or if it's in pounds or whatever? Yes. The global community has gotten together, and what I'm demonstrating to you right now is shown in GAAP, Generally Accepted Accounting Principles. And that's why I'm showing you a very simple balance sheet that follows GAAP, generally accepted accounting principles. And I'm going to do the same thing with the income statement. So let's take a look at the income statement. So that is the balance sheet. Now let's look again at income statement, which is again the P&L, which is the revenues, expenses, and net income at the bottom. So this is an example, again, excerpted from the book. You got revenues at the top, expenses in the middle, and then you got wages, or I'm sorry, and then your total expenses, and then your net income. So let's look at this. So at the very top here, you have revenues. So this is, you might notice that it's broken out between product sales and service sales. That's not uncommon. Let's say for argument's sake that this is an HVAC company or some sort of service business. But if you look at more sophisticated financial statements, income statements, there might be 10 different line items there for revenues. So just want to make sure that you understand, like I did break this out between product sales and service sales, just so you can see that there are sometimes they delineate between two different forms of income, two different revenue sources. So that is the revenues. The expenses, you're going to see here that, again, this is just stuff that runs the company. This is the stuff that you paid out. So let's say for the month of October, from October 1st to October 31st, you paid out $34,000 in raw materials. You paid out $5,150 in insurance expense, and so forth and so on, all the way down to wages. Total expenses equal $96,320, and then you have net income equaling $17,680 for the month. Okay. Now, again, this could be for over any period of time, right? This could be represented over a year, could be a quarter, anything along those lines. So I just want to make sure that you understand that this is a moment in time. So this is the income statement in totality. So you might say, okay, well, what does this have to do with the price of tomatoes? Like what does this mean? Why does this matter? Why should I even care? I'm glad you asked. So this is one of the main things. Now, this is the basics of financial statements. Now, is this not so scary? Who's like, okay, yeah, I can understand this so far. Just let me know in the chat. Like, are you tracking me so far? Is this easy? Just say, yep, I'm with you, or nope, I'm completely and totally lost. Can't imagine you guys would be totally lost. But again, I want to make sure you guys understand that. So please go ahead as I take a sip of my water. Let me know that you guys are tracking me right now. Okay. All right. So we're going to go ahead and put that in the chat if you guys have any questions on that. So the next thing we're going to get to is where's my cash? Where is my cash? Where's my cash going? Because you're like, oh my gosh, I'm growing. And now we're starting to plan on a little bit of growth planning. You cannot be strategic if you don't know your numbers. If you don't know your numbers, it's going to be really hard for you to have any sort of strategic planning whatsoever. Thank you, Michelle. Appreciate it. So this is really important because remember when we talked back in so you have vision, infrastructure, and process, and in process you had that strategic planning component. The strategic planning, really hard for you to be strategic if you don't know your numbers, if you don't know your financial numbers, if you don't know what kind of money you've got coming in that could pay for growth in the future. So this is why you want to know these things. And you also want to avoid growing broke. So let's look at the three key metrics that we're going to be talking about. We're going to be talking about, first and foremost, profit margin percentage. We're going to talk about cash balance history, and we're going to be talking about cash as a percentage of sales. But we're going to specifically start with profit margin percentage. And this is exactly how you can grow broke. So let me get myself taken down here so you can see the financial statements nice and clear. And what we're going to be paying attention to on the financial statements is these numbers here on the right. So you see that green circle there? Again, it's right there. And for those of you, I know I mentioned it in the beginning, but you will be getting a replay if you guys are questioning this, because I know people are like, where are we going to get the replay? We're going to be emailing it to you. We're going to upload it to YouTube, and you will be getting a replay on this. So if some of you have to hop off, I totally get it. So first and foremost, we're going to be paying attention to those numbers on the right side. So when we're looking at the income statement, again, this is the top portion of this. I just want to make sure you're looking at the top portion of the income statement. So we're looking at revenues, all right? Melvin is here with the worst toothache I've ever had. Wish me well. Oh man, that is awful. I'm sorry, Melvin. Hang in there. If you need to hop off, just want to let you know that we will be getting the replay here. Get some Orajel or something. That sucks. Toothache pain just is the worst. So when you're looking at your revenues, right, the thing that what I want you to pay attention to is again, you might notice that I broke out between product sales and service sales. And if you notice the numbers on the right there, the 65.8% versus 34.2%, this is important for you to know because you might know where most of your margin comes in. Let's say for argument's sake that you keep 80% of your service sale revenue because you know your costs. You might say, well, that's great, but I'm only having, out of the $114,000, only 34.2% of that 114,000 represents service sales. So you might want to say, well, how do I increase my service sale revenue, right? How do I promote that? That would be really good for you to know. So maybe you can tell your sales guys to start maybe pushing more for more service sale revenue rather than product sales. Okay, so this would be important for you to know, or vice versa, right? If product sales has a higher margin, meaning you get to keep more dollars, then you want to have your sales guys do the opposite, press into product sales or whatever, right? So this is why it's important to carve that stuff out. But when you're looking at at these numbers, okay, I want you to look at numbers on the right-hand side. So your total sales at the top is 114,000, and that's 100% of sales, right? So that's, again, because it's 114 divided by 114, that's 100%. So when you're looking at raw materials, you see the number on the right where it says 29.8%. That is 29.8% of sales. And you're thinking, well, what does that have to do with anything? It doesn't really have much to do with it. But if it's basically you're dividing that 34,000 divided by 114,000. So again, that's how you're coming up with that percentage of sales. If you go all the way down there at the bottom, where you see where it's 15.5%, that is your profit margin percentage. That means you get to keep 15.5% of $114,000, your total sales. That's your profit margin, your basically profit margin percentage. And that is really important to track. I know a lot of owners love to just see the bottom line number in terms of the dollars in their bank account, but it's really important that you track the profit margin percentage. So the way you track that is you just take 17,000 divided by your total sales for that period. So you divide it by 17,680 divided by 114,000. That gives you 15.5%, right? So 17,680 divided by 114,000 is 15.5% net profit margin percentage. So what does that have to do with anything? All right, so let's take a look at this. Now follow me here for just a hot second, okay? If you don't pay attention to anything else, but just pay attention to this for just a second, okay? Right? Let's pretend you have a company that has $10 worth of revenues, and you have expenses of $8, that gives you a profit of $2 and a net profit margin percentage of 20%. Okay, $2 divided by 10 is 20%. So let's pretend that your expenses go up $1. So you're like, shoot, I want to maintain my profit margin of $2. So what I'm going to do is I'm going to raise my pricing by $1. So remember, your expenses go up $1, so they go to $9. And your profit margin, or you want to maintain your profit margin of $2, so you raise your prices $1. So let's see what happens. So you go and you raise your prices $1. So now your revenues are 11, your expenses are 9, and your net profit is $2. But what happened to your net profit percentage? What happened to your profit margin percentage? Your profit margin percentage went down. Your company is now less efficient at making dollars. So this is really, really important. So your company is now less efficient at keeping dollars in the company because you have not priced yourself high enough. This is why companies during periods of inflation do very, very well, because what they do is they price themselves higher. So in order to maintain that profit margin percentage of 20%, let me take myself back down. What you should have done is, instead of raising your pricing $1, you should have raised it $1.20, which would have put revenues at $11.20. Your expenses would have maintained it at $9. Your net profit would have been $2.20, but it would have maintained that net profit margin percentage of 20%. Does that make sense? This is really, really important to understand, because the people who don't understand this are the ones who will grow broke. They will like, oh, I feel bad for my customers, I don't want to raise my prices. Man, it's about your survival. And I'm not suggesting that everything, you do have to raise your pricing. Then increase your value somehow. Find other ways to increase value so you can charge more money. It's not about just raising prices. Find other ways to bring value. I continually find ways to bring more value to my customers because I don't want to just say, well, I'm just raising my prices because, I got to maintain my profit margin percentage. Why would they care? Why would they care? They're like, well, that's great, but I need to maintain mine too. And you're kind of harsh on my mellow, right? So increase your value so you can charge more money, right? That's what I'm saying. Like, find other ways to deliver value to your clients. Melvin's got some. Don't know what I would do without these business meetings. It's the only thing that makes the day better. Finding ways to bring value. Very good. Yeah, over deliver. Yeah. So, Melvin, have you been on these sessions before? I feel like this is you've been here before. I've seen your name seems familiar. I do apologize if I don't remember. I've been doing a lot of these lately. So this is really important. So I just want to make sure you understand that you are maintaining. Yeah, I thought it was your. I thought you've been here at least your second or third time. Very good, Melvin. I'm glad to have you back. So this is really important to maintain your profit margin percentage. And this is where, like, again, you would raise that pricing again, more to maintain that profit margin percentage of 20%. So where's all my cash? So we talked about growing broke. Now there's other ways to grow broke. I don't have the bandwidth right now. I don't have the time, unfortunately, to give it all because I want to make sure I get you guys out of here at a reasonable time. But here's the thing. Let's get you some resources so we can talk about the other metrics around profit margin percentage. So we talked about profit margin percentage or other key metrics that are important, the KPIs. We're going to talk about cash balance history, and we're also going to talk about cash as a percentage of sales. So these are pretty straightforward. These are not difficult to calculate. So let me again bring myself down so you can see the whole screen. So basically when I'm tracking my cash balance, I track that separately from my balance sheet. So yes, this is actually tracking it. So at the end of each month, I want to see, for example, that my cash balance has actually grown. And that cash in my bank account is like it's like an insurance policy that I don't have to pay a premium for, right? Now you might be thinking, well, yeah, you're losing purchasing power though if you keep all that cash in the bank. Okay, then even if I kept it in a interest-bearing checking account or interest-bearing savings account, yeah, I know I'm not earning that much money, but my point is, this is what helps mitigate risk. And I'm just telling you this right now. I had studied this book that was written by Jim Collins and Morton Hansen. It was called Great by Choice. And they studied 30 companies over the course. I'm sorry, they studied 16 companies. They studied 16 companies over the course of 30 years. And they had a control company which did really, really well over the course of that 30 years. For example, Southwest Airlines, right, which had unbelievable growth. And then they looked at a comparison company which had very similar business plan, very similar business model, and they existed during the same time frame. Pacific Southwest Airlines went out of business. Southwest Airlines is the dominant air carrier in the United States today. And they are worth, I don't even remember, I think the market cap on them is right now is 18 billion with a B. So they are a massive company, and they track them from startup. So the interesting thing, and they tracked companies like Amgen, Microsoft, Intel, right, Stryker. So they tracked all these businesses, and the ones that were these amazing companies that had amazing amounts of growth, 23 times the market, 53 times the market, 63 times the market, right? Microsoft, the ones that had the most amount of growth had anywhere from 3 to 10 times more cash on their balance sheet than their industry counterparts. And that is compelling. That, don't believe me? Look at how much cash Google has on its balance sheet. Just type it in. Find out how much cash Google has on its balance sheet compared to its total market cap. Look at Berkshire Hathaway. Berkshire Hathaway, almost a third of its value is in cash and cash equivalents, because these people understand that holding cash and cash equivalents, it helps mitigate their risk. And it allows them to take advantage of good luck events when they come along, and it allows them to weather bad luck events when they come along. So I'm just letting you know, for me, I always love being fat on cash because I'm telling you, it helps mitigate my risk. So this is really, really important. So track your cash balances every single month. And I don't care if it goes up $1. It better go up $1, it better go up something. But I want to make sure that my cash balance is going up. So that's cash balance history. The next one is a little complicated. Now I say a little complicated. It's called cash as a percentage of sales. And this is something that really helps me manage my risk. So if I'm looking on this, again, what I'm going to do is I'm going to take two numbers. One is going to be from the balance sheet, and the other one, let me get this down the bottom here. So one is going to be from the balance sheet, right? We're going to take that from the assets. We're going to take that from the cash. Okay, so I'm looking at my cash balance here of $10,350. And the next one I'm doing is I'm going to take this from my total sales. Okay, so I'm going to take my total sales number of 114, and I'm going back. Let me go back to the balance sheet. Okay, cash balance up top there. I'm taking that cash balance at the end of the month, say 1031, and then my revenues for the entire month of October, 114, right? So now what I'm going to do is I want to do a simple calculation of cash as a percentage of sales. So what I'm basically doing is just dividing my amount of cash into the amount of sales. That's 8.7%. So that means 8.7% of my sales I'm holding in cash. Now you might say, is that good? Is that bad? Like, I don't know what to tell you if it is good or bad. I'm just saying it's a metric that I track. And now just stop for just a hot second here. Let's pretend that $114,000, the amount of sales that I have every single month, right? And I'm only holding $10,000 a month in cash. Doesn't sound like a lot, does it? That to me, I would probably want to see a little bit more. Personally, for me, I would want to be looking at probably something closer to, maybe like having a full month's cash or two, right, of revenues, right? For me, it depends on the business. It depends on a lot of other factors. So I just want to make sure that you understand, like, it's just situational. But I will tell you what does matter is when I'm looking at the trend. Okay, so I'm going to put myself back down here in the corner, and you look and you see again. So January, again, this is me tracking my numbers. So I'm looking at January, it's 8.7% of sales. February is 9.2% of sales. March is 11.3. So is that good? You're like, say, well, maybe it is good, but keep in mind, it might not be good. Why might it not be good? Because it's a function of two numbers, right? The numbers. So it could mean that my cash is going up, or it could be that my sales is going down. Right. So it's situational. It just means the thread that I need to pull on. It just means something that I'm looking at. So I just want to make sure that you understand that just because something is going up doesn't necessarily mean that it's good. I mean, if my sales is going down, is it just because it's seasonal? And it's like, okay, yeah, my cash is good. I'm still holding my cash balance. So it might be okay. But I just want to make sure that I'm looking at things from an apples to apples perspective. So I'm not here to make you into chief financial officers overnight. This is all stuff that I have navigated well, and I know this backwards and forwards. And when I'm working with a client as their advisor, as their strategist, I'm utilizing all the tools from my toolbox for the four core functions of business: for lead generation, for sales, for operations, for accounting. And these are all the different numbers that I'm looking at. And again, like I said before, you cannot be strategic if you don't know your numbers. And again, you want to make sure that you avoid growing broke. And again, just make sure you're tracking the things that you need to be tracking. You have to know your numbers. You have to track your numbers. And there's just no way of getting around that. If you'd like, this is the end of the presentation. So I'm just going to give you a couple of resources here. Hopefully you found this somewhat helpful. This is, and again, you'll be getting the replay of this here in, in probably obviously tomorrow, because we're near the end of the night. But if you'd like to join our free Facebook community, Michelle was going to go ahead and put that in the chat there. It is, obviously, we're not going to blow you up all the time, and we put some content in there from time to time that might be interesting to you. So if you'd like to join, just don't be a jerk. We don't allow jerks. We don't want jerks in our community. So you can click on that link. If you would like further events, it seems like Melvin here is a repeat offender. So that's great. It's great to have him back. If you guys are interested, what I would suggest is follow us on EventBrite, because then you'll get anytime we put up a new thing, whatever that new thing is, you will get you'll get a notification of it. Sometimes we send out emails from EventBrite, but not always. We just don't want to spam people. But go there and follow it. There's 10 right now. There are 10 different courses that you can take. All of them are free. So just if you are interested in that at all, let me talk to you really quickly about a free money and finance course. It is 100% free. And I just want to tell you a little bit about what that is. So if you are interested, you can go and learn about the free money stuff and all of the templates that I referenced here today. Like I referenced some of them, like you'll see some of these things in the actual free money course. So the free money course, Michelle just put in the EventBrite thing, so if you want to track that. But the free money, so there's, in terms of the money templates, there's a chart of accounts example. If you're like, what's a chart of account? Basically, any line item that shows up on your balance sheet or income statement. When I say a line item, like accounts receivable, that's a line item. Your checking account balance or your checking account, that's a line item. The line item that said Wells Fargo bank loan, right? That's a line item. So any line item that shows up on your balance sheet or your income statement is going to be on your chart of accounts. That would be good for you to know, right? It would just be good for you to understand what that looks like so you can see it. So you'll see a chart of accounts example that's in there. And this is all it's all in a spreadsheet template. So you get to utilize this. There's also a very basic balance sheet example that you'll see, and you can kind of play with it a little bit. You can play with the numbers so you can see what a little bit more sophisticated balance sheet looks like. And again, this is all free. There's a basic income statement example. So again, you'll see the revenues, you'll see the expenses, and this is all stuff that is 100% free. So you can kind of get a better understanding of what it is that you're looking at today. There's also a balance tracking template, like I talked about, like you can track your balances, and just a simple template that you can use to track different balances that are important to you. Personally, it's cash balances. Like I said, cash is a percentage of sales and net profit percentage. Those are the three that I would absolutely want you to track, but you can track other balances. You can track credit card balances just so you can see those balances going down, hopefully, right? Or other balances going up, obviously things like checking accounts and so forth. So that is your balance tracking. You can do an underwriting. So for those of you who actually want to borrow in the name of a business, I actually demonstrate an underwriting template in here so you can actually see what underwriting looks like from both a real estate perspective and also from a manufacturing perspective. Because as an underwriter, I was actually an underwriter for a bank for a number of years. They are underwritten a little differently. Looking at a real estate loan versus looking at a manufacturing or service type business, those are underwritten differently. So those are two different things. But there's a personal financial statement. If you are looking to borrow in the name of a business, they're going to ask you to fill out a PFS, personal financial statement. And this is a template that you can use. You can fill it out, print it off, and there's even a spot for you to sign it, which they want you to sign it. So there is this is what I mentioned earlier. There's real estate, which is also known as a DSCR loan. I just used to call it a commercial loan, but now they're called DSCR loans. So it shows you how to underwrite it. Just examples there. And then there's videos that support all of this stuff. So you can go through understanding balance tracking, balance sheet basics, the income statement basic training, just understanding the basics, profit and loss stuff. Borrowing as a business, that's a very basic stuff. Some collateral based lending, things like that. Term loans. And even things like what's called a UCC1. So if you're in the United States, they file what's called a Uniform Commercial Code, I think is what it stands for. Actually, I don't even know that I knew what it stands for. I think it is Uniform Commercial Code, I think is what it stands for. I could be wrong. Anyway, UCC1, they file that based on when you get a commercial loan, and they'll file that against your company. And that's just kind of to collateralize things. So that's all different stuff. And that is all in the free version of the Money and Finance course. Michelle already put the link for that in there. To where you actually log into this again, you would go to strategicboardroom.com, and there's courses and logins, and there's just find where you can log in, and you can just click on the link, and it's pretty straightforward. So if you can follow directions, you can follow it, and you can find it pretty easy. So that's the free version. If you are looking for something a little bit more advanced, right? I'm just letting you know everything that I just said is already also going to be in there. All the money templates I just talked about, the chart of accounts examples, the balance sheet example, the income statement example, the balance tracking examples, the underwriting templates, personal financial statements, et cetera, et cetera. Borrowing as business, advanced income stuff. There's also a CapEx calculator. So capital expenditure. It's how to calculate CapEx based on length of time, right? So you're actually amortizing something over a period of time. There's something known as accounts receivable aging, and also accounts payable aging. The aging reports are really, really important for you to understand, especially if you're going to be holding accounts receivable or you're going to have accounts payable. So accounts receivable is the money that's due to you from your customers, right? That haven't paid yet. And your accounts payable is what's due to vendors. Understanding your aging report is really critical, especially if you're going to be borrowing and especially if you're going to have accounts receivable, and really to make sure that you're actually getting paid on time. Because if your accounts receivable gets too old, people will just stop. They'll just stop paying you, and you're like, oh, I wonder why I'm out of money. Well, your accounts receivable is a train wreck, so this is why it's also good for you to track. There's also a whole video series that also educates you on all of this stuff. So there is the basic accounting, the general ledger, the chart of accounts stuff. Like that's lesson one. All the other videos that I mentioned before, I'm not going to go into all those, but how credit scores actually work based on what they don't tell you. I'm telling you, like, credit scores are actually a wonky thing, and there's not just 3 credit scores. There's actually closer to like 9 or 10. Just depends on what you're looking at. So you don't know this, and you wouldn't know this because even the banks don't know this. They just take the number and they go, oh, your score is this. And you're like, that's not what I saw on Credit Karma. And that's not what I saw on my credit report. I'm just going to show you how it works. So that's important, even from a personal financial perspective. There's certain metrics that every business owner must need to know. So I want to get into more advanced metrics than what we did tonight. But these are different things that you're going to. I'm going to talk about a flash report here at the end. But these are things that you would show up on a flash report, so you know different things that would be important to know. You're also going to be looking, like I said, advanced metrics. There's going to be balance sheet metrics. There's return on investment, ROI. Again, this is where you're going to get in a little bit deeper on the aging reports, and again, something called a flash report, how to actually create a flash report so you know, like at any given time, where your numbers are. This is where you're managing by metric. And also a powerful loan calculation and debt reduction tool that I call the loan constant. I kind of referenced it earlier on, where if you have $10,000 worth of credit card debt and $10,000 worth of amortizing 30-year loan, what would have the lower payment? Well, obviously the 30-year amortizing loan, because it's amortizing it over a longer period of time. The credit card debt, although it's much easier to get into, it's going to have a higher loan constant. So it's really expensive debt on your cash flow, and understanding how to deleverage yourself using that kind of calculation and get out of debt much faster. And it also helps manage your risk a lot better. So all of that stuff there is, one other thing. Oh yeah, I forgot about this. This is one thing. This is really, really powerful. This is actually how I hold a lot of cash, is something called infinite banking. So I go through this very detailed explanation of how to hold cash inside the cash value of a life insurance policy. I do not sell insurance, but I can certainly connect you with someone who does this sort of policy. And I'm just letting you know, the infinite banking concept is something that I personally use. And it is, I'm telling you, Dave Ramsey hates it. I get it. But Dave Ramsey, I'm telling you, he doesn't understand it. Or if he does understand it, it would actually mean he would have to stop talking about term debt or term life insurance. And I know that's kind of against who he is. So anyway, all of that is $37. If you're interested and you buy it tonight, okay, if you pay it tonight, I see the $37 come across tonight, I will also throw in a 30-minute strategy session with you. So that would be, we can talk about really whatever it is you like, but you got to buy it tonight. So that means like tonight at my midnight Eastern time. I'm not going to be wonky about it. Like you're like, oh, I'm going to do it, but I got to do it tomorrow. Just do it tonight. Do it tonight. That way we can go ahead and get you scheduled. And that's just $37. So Michelle went ahead and put the link in there. That is all I have. And so if you guys have any questions, I'm happy to field anything, but otherwise, thank you so much for sticking around. And look, I'm kind of putting landing the plane here just a few minutes after the top of the hour. So thanks again for sticking around, and I really appreciate you guys. So keep an eye on your email for the replay on this, and I will look forward to seeing you guys next time. Thanks so much.